Every day, trillions of dollars change hands in the global equities market. To the untrained observer, the flashing red and green tickers look like a chaotic casino, driven by pure luck and adrenaline. But is the stock market truly a gamble, or is it a rigorously defined science? The truth lies in your time horizon. In the short term, markets operate as a voting machine, heavily swayed by human psychology, breaking news, and speculative momentum. Traders utilizing extreme leverage are essentially placing high-stakes bets on unpredictable price swings. However, over the long term, the market transitions into a weighing machine. It rewards structural growth, corporate earnings, and fundamental economic value. To understand this dichotomy, we must dissect how data and sentiment collide on the trading floor.
Let us first examine the science of investing. At its core, buying a stock is purchasing a fractional ownership stake in a real business. Professional analysts rely on objective frameworks, such as discounted cash flow models, to determine a company's intrinsic value. This is where the math supersedes the madness. By analyzing historical earnings, debt ratios, and profit margins, investors can make highly rational decisions. Furthermore, the true scientific power of equities is realized through compound interest. Reinvesting dividends over decades creates an exponential growth curve that systematically builds wealth. When approached with discipline, a focus on valuation, and a multi-decade horizon, the stock market closely mirrors a deterministic financial science rather than a game of chance.
Yet, the scientific method frequently falls victim to human emotion. This brings us to the speculative side of the market, where greed and fear take control. Behavioral economics teaches us that humans are not strictly rational actors. During market bubbles, irrational exuberance drives asset prices far beyond their fundamental value. Driven by the fear of missing out, retail and institutional participants alike abandon valuation models for momentum trading. The use of margin debt amplifies this effect, transforming calculated investments into leveraged gambles. In these environments, stock prices decouple from reality. A single macroeconomic rumor can trigger massive sell-offs or short squeezes, proving that market sentiment can temporarily overpower financial physics.
How then do we navigate a landscape that is both mathematically predictable and psychologically volatile? The answer lies in rigorous risk management. By acknowledging the gambling elements of the market, disciplined investors build defensive frameworks to protect their capital. The cornerstone of this defense is diversification. Spreading investments across different asset classes, sectors, and geographies mathematically reduces unsystematic risk. It is the financial equivalent of not putting all your eggs in one basket. Combined with strict position sizing and an unwavering focus on long-term goals, investors can neutralize short-term speculative noise. Ultimately, the stock market is what you make of it, a destructive casino for the impatient and an engine of scientific wealth creation for the disciplined.